Welcome, everyone. Today, we're going to tackle one of the most important and, honestly, one of the most complex anti-avoidance rules in Canadian tax, the tax on split income, or as we all know it, TOSI. For you, as future tax professionals, getting a rock-solid grasp on this isn't just a good idea, it's absolutely essential. So, let's dive in.
Let's get started. To really understand TOSI, you can't just memorize the rules. You have to understand its story. So we'll start with the why, the problem that government was trying to solve. Then we'll trace how the rules were born, how they grew up, and, most importantly for you, how you're going to navigate this maze in your careers. Let's go right back to the beginning.
Okay, so before there was TOSI, there was a tax planning strategy that was specifically designed to shut down. And for many, many years, this was a perfectly legitimate and, well, a very effective technique.
So, the central question for tax planners back then was pretty simple. How can we leverage Canada's progressive tax system to a family's advantage? You all know how our system works, right? It's like filling up a series of buckets. Your first dollars are taxed at a low rate, and as you earn more, your income spills into buckets with higher and higher tax rates. The whole goal here was to find a way to use the empty, low-tax buckets of other family members.
And that strategy has a name: income sprinkling. It was all about using a private corporation to pay dividends to family members. This was especially powerful when those dividends went to minor children, because, they usually have little to no other income.
And this slide really nails the so what. The difference was huge. On the left, you've got the business owner taking all the income and all the tax hit at their very high marginal rate. But look at the right. By sprinkling that exact same income to a child, the family could use the child's basic personal amount and their low tax brackets. The result? A much, much smaller overall tax bill for the family unit. Well, the government saw this happening and decided it gave private business owners an unfair leg up. So they responded, and they responded directly, with the tax on split income. At first, it was laser-focused on these payments going to minors. So the rules created this brand new category of income called split income. This wasn't just any old dividend. It specifically targeted dividends from a private company paid to a minor child, especially when a related person, like a parent, was involved in that business. That family link was the key trigger. Now, this is the heart of TOSI, and you have to admit, it's pretty clever. The government didn't make the payments illegal. Not at all. They just made them completely, utterly tax inefficient. By slamming that income with the highest possible personal tax rate and taking away most of the personal tax credits, poof, the entire tax-saving benefit of sprinkling just evaporated. The incentive was gone. Of course, tax advisors are creative. The obvious next thought was, okay, if we can't pay dividends, what if we just sell the shares instead? Well, the government saw that coming a mile away and slammed the door on that loophole. This rule is critical. If a minor sells shares to what's called a non-arm's length person, basically family, the capital gain that results gets recharacterized as a dividend. And you know what happens then? It gets hit with the full force of TOSI. Game over.
So for a while, the rules for minors were pretty clear, but tax planning moves on, and so does the government. And in 2018, everything changed. The entire landscape shifted. The government brought in one of the biggest changes to private company taxation we'd seen in a generation, and TOSI suddenly grew up.
Just look at this timeline. It tells the whole story. Before 2018, TOSI was all about kids. After 2018, it was a whole new ballgame. Suddenly, adult family members, spouses, adult children, you name it, were brought into the TOSI net. This fundamentally changed how we had to think about family business tax planning.
The logic here was pretty consistent with the original idea. The government basically said, look, if family members are genuinely contributing to the business with their work or their own money, fine. But if not, they shouldn't get the benefit of a lower tax rate. Okay, this next section is probably the most important part of this entire discussion for your future careers. If TOSI now hits adults, how in the world can they get paid from the family business without getting slammed by this tax? The answer is in a series of very specific exemptions called the exclusions. Mastering these exclusions is absolutely crucial. Let's start with the three most common bright line tests. We call them bright line because they're objective. They're black and white. You either meet the test or you don't. There's no gray area, which is great because it gives us certainty. All right, here's the first number I want you to burn into your memory. 20 hours. An adult, 18 or older, is exempt from TOSIOS if they are actively engaged in the business. And the law tells us exactly what that means, working an average of 20 hours a week. But here's the really neat part, the flexibility.
This test can be met in the current year or, and this is huge, in any 5 previous years. That look-back rule can be a real lifesaver for a client.
The second way out is for owners, not just workers. An adult who's 25 or older can be exempt if they own at least 10% of the company's shares, and that's measured by both votes and value. But, and please pay attention to this, there's a massive restriction. This exclusion generally does not work for service businesses or professional corporations. Think doctors, lawyers, accountants. This is a very common trap people fall into.
And here it is, the full checklist. This is a slide you'll want to come back to again and again when you're working with family businesses. You can see the 2 big ones we just talked about, excluded business and excluded shares, but look at the others. There are special rules for spouses over 65, for gains on qualified small business shares, that's a whole other course really, and even rules for more distant relatives. It's a complex list, but it's comprehensive.
So what happens if you have an adult family member who gets a dividend, but they don't quite fit into any of those nice, neat, bright line boxes? You know, what if they work 15 hours a week, not 20? Or own 9% of the shares, not 10? What then?
Well, in that case, you fall out of the safe harbor of the bright line tests and into the murky waters of a subjective test. The Canada Revenue Agency gets to look at the payment and decide if it was reasonable based on that person's actual contributions to the business.
This is basically the CRA's backstop. It's a catch-all to stop payments that just don't pass the smell test. So, for example, if you pay a $100,000 dividend to a spouse who maybe does 5 hours of basic bookkeeping a month, well, that's almost certainly going to be deemed unreasonable, and that entire amount will get reclassified as split income and taxed at the highest rate.
All right, let's wrap this up and bring it all home. When you're sitting across the table from a family that owns a business, what are the absolute key things you need to remember from all of this?
This quote really says it all. TOSI analysis is not something you do at the end of the year. It's not an afterthought. You simply cannot ever make a payment from a private company to a family member without first running it through the TOSI gauntlet. It has to be step 1 in your thinking every single time.
And that right there, that is the new reality. This is the critical thinking that TOSI forces on you as an advisor. For every single dollar that leaves that corporation and goes to a family member, you have to classify it. Is it a reasonable salary for work they actually did? Is it a dividend that safely fits into one of those bright line exclusions, or is it split income that's about to be taxed into oblivion? Answering that question correctly, well, that's now a fundamental part of tax planning for every single private family enterprise in Canada.